Walk me through a little bit about this results-driven financing. And part of it is that economics of traction as well that we just talked about too, is just, what are the milestones? How are you getting it done? How are you getting that traction? Let's break that down a little bit.
Welcome to She Invests. Join us every week for conversations focused on the growing number of female angel investors, the real unicorns. You'll hear from existing female angel investors, VCs, and fund managers on their investment thesis. From deal flow to exits, they will share the best practices that contribute to their success. Female angel investors will be equipped with the tools and resources to confidently activate their capital in order to make an impact in their community and the global economy. With your host, active angel investor and founder of Hera Angels, Dr. Silvia Ma.
Kim Folsom is a fantastic serial entrepreneur and VC fund manager. She has founded two fantastic accelerators. One is the Lift Development Enterprises, Inc., and she co-founded and is the CEO of Founders First Capital Partners, a small business growth accelerator and revenue-based venture fund focused on helping underserved employer-based small businesses with funding to achieve exponential growth. She is a high-tech executive and serial entrepreneur with 25 plus years of experience growing innovative technology companies. She has experience founding, leading, and building startups for which she has raised a wonderful $30 million in institutional venture financing. She has experience founding, leading, and building startups for which she has raised a wonderful $30 million in institutional venture financing. Ms. Folsom also earned her MBA degree from the University of Pepperdine and a bachelor's degree in information systems with a minor coursework in economics from San Diego State University. Welcome to the show, Kim.
Oh, thank you so much. I'm so delighted to be participating. This is great.
Wonderful, Kim. I know that we've seen each other. We've interacted for so many years. Can you give us a little bit of background of why you've become who you've become and in that diversity space in investing in female entrepreneurs and in diverse leaders?
Sure. So I have been truly, truly, truly blessed. And every day I am thankful to wake up and continue the mission that I'm on and just recognize just how many unbelievable blessings that I've had from having a dad expected that I pursue a career in STEM and starting out as a software engineer to all the innovative companies that I worked for and then taking the leap and being an entrepreneur for over 20 years and launching and growing and funding and over 6 companies. That was 20 years ago when I first started. And even when I started on my corporate career, there had always been a gap. It's just the difference between, now versus 30 years ago. There weren't all these names and statistics to back it up, but, there still was the hidden figures experience for women and minorities pursuing careers in tech, as well as when you look at the entrepreneurial story, there's so much talked about with the guys that are pursuing the entrepreneurial journey, be it, the Ray Koch story or the Ford story or the Steve Jobs or Bill Gates, but not necessarily one for women and minorities. After I sold my last company in 2013, seeing that gap still existed. And the difference was there was more conversation about it and statistics and names to it. But you still had that gap of, less than 1% of $1 million companies are run by women and minorities. And even to the point where the interesting stat that one of my partners had shared with me, 1 in 5 businesses, if you look at a family that's led by a white male, 1 in 5 of his family members, and that's, within his immediate and surrounding families, are running $1 million business. But when you compare that to the perspective of a minority founder, especially, African American or Latina or Latino founder, it's more like 1 in 500 or, even a bigger number. I just felt that, given my blessings and my journey, that I have a unique experience to help solve that problem. And I also looked at it from the standpoint, it was more than money. It's more than money that's going to solve that problem. And so, launched an accelerator and a fund to use my take on a solution to it.
What was your primary impetus when, well, not impetus, but let's say your experience within that whole career? What really fueled that? I want to make this difference. I know we're going to talk about that accelerator piece, but in your personal life, in your career, what was it, those things? I know we talked about your dad. What were the things that really helped you as a person go forwards and really make that impact in the industry that you were in?
Well, I was always curious, and always wanting to solve problems. And maybe it's one of those from a behavioral or driven standpoint. I'm a middle child as far as the sibling ranking. So it's like always wanting to, do stuff to solve a problem, to, make it better for people. And so given that curiosity and the love of solving problems, a appreciation and for innovation and, on the tech side, early loved math and science. So going for that. And also, what is the statement that's part of that play Hamilton? Always striving to the next thing. The things that I did in school, high school, taking on challenges, it's like, I want to do that. I can do that, and having fortunate, nurturing environment that, you can do anything that you want to. Don't let anything stop you. As long as you want to do it, you should do it. And you're qualified to do it. So, you can figure that out.
I love that, because that's one of the things that we find a lot with women entrepreneurs is that confidence, is being able to say, look, I want to take these challenges. I am confident enough. I am qualified enough. I need to take that challenge. So I love how you just took that on. And I think part of it too is dreaming big. You always think outside the box of how do you solve that problem, even if it's a big problem.
Mm-hmm. Yeah. I mean, what's the saying? You got to have those big, hairy, audacious goals. Those have been a motivator and a driver. And even though you have some of those challenges that occur that stop you, and those can either be instances or people or perceptions or different expectations, you just can't let that steal your joy, if you will. So, I just keep moving.
I love that. And that's part of the reasons why you launched Lift and Founders First. What were the specific problems that you saw that you said, hey, you know what, I'm going to create this accelerator. I'm going to create this opportunity for others to actually thrive in the startup world?
I would say answering that question, some stats that, back it up. But the other, my experience as a founder, with my companies, I was fortunate enough to raise other people's money, venture money from institutions, and really learn and had a chance to work for venture-backed companies and seeing kind of the whole life cycle from idea to exit, because I had that experience with a couple of them. What people think, it's almost like if you compare that to, the many types of stories that we women are raised with, that you're going to have a guy come on a white horse and have all this stuff happen. But there's a lot of things that happen in the middle that you have to have happen. I was just talking to an investment group just before we started this session. On one extreme, there is the perception that if you're a woman in a minority or an underrepresented or first-time founder, people won't fund you. And then on the other extreme, there is for the folks that have access to capital. And as they look at this market, it is either they're not qualified, I don't know anybody that's qualified, I don't have access to that network. And so as a result, it's too few and far between if you invest, in that business that has that profile that you're going to get your money back. But if you look at it from the other side of it, most people learn how to make money. This is not an innate skill. Having a business is more than just making money, but to survive in a business, you need to be generating sufficient value such that you can not just survive, but thrive. And, economics is a big, big, big piece of that. But that's a learned skill. Many of the guys that you see running these businesses, they learned from somebody else. And, you look at the, Fortune 500 companies, many of those companies, the CEOs, they were, other C-level responsibilities, VPs, and all those other things at some other company. And they learned their way to get to be that person. That's one evidence of it. And then when you look at some of the newer companies, the newer innovative companies, be it, the Facebooks and the Airbnb and the Ubers and all of those things, they have the benefit of an ecosystem that teaches them how to think big. It's not just, I have an idea to make it so that people could transport themselves. It's like, this is a problem that's bigger than just my town. This is a problem that could be across a country or globally. All of those skills are learned. Knowledge transfer is not just relegated to some single gender or some single race or some single geographical standpoint. So taking it from that perspective, it's possible. And then when you back it up with the stats of 95% of businesses, medium and large businesses are led by non-diverse folks. So, as a result, the people that are in, those diverse perspective founders, generally they're in individual contributing roles. They're not in the position of growing a company or running a P&L or hiring and training and developing or, all of those things. As a result, when they decide because of either economic or emotional other responsibilities to be downsized out of that large and medium-sized company and they start their own business, they don't have the skills necessary to grow that business. So many of them start businesses such that they end up being solopreneurs, maybe them and their buddies. They start something and they're kind of stuck because they don't know, well, in order to get access to resources, you have to operate in a specific way. You have to have a certain gross margin. You have to, have a distributed customer base. You need to have economic model that provides for more predictability as far as cash flows and all of those types of things. Those are all things that can be learned. And so we look at it as if you can get someone that's started something and they're coachable and an opportunity that could take advantage and solve a good sized problem. We will help you on the one side and then provide you with capital on the other side to help you solve a problem for a niche market.
And the mentors that you have are also diverse as well. I find that as well is that when we have great startups and they're put in front of like-minded, like-looking individuals, they actually thrive more because they say, oh, I can be that person, correct?
Yeah, some of it, again, this whole extreme standpoint of why there's this gap or underserved, there's a lot of meritocracy. Mirror, meaning I am often going to find someone else that's similar to me because I know what I do. And I know that if somebody else find somebody else similar, then they could do it too. Having that mentor or coach that has not only done what you're doing, but also have some of the social or soft or personal similar journeys that can be helpful. But it doesn't have to exclusively be that because, in my career, most of my mentors were white guys. I was fortunate in that, I had somebody that either for a variety of different situations, they helped mentor me to, get to a specific level. Many a times I had to have that discussion of saying, well, I want to get to the same level you are, or I want to get to the same level that guy is, or I want to do this. And it's like, really? Gosh, I would have never thought you would want to do that. And it's like, well, why not? Because that other guy, he did it. And it's like, well, gosh, I never expected. And it's, so once you get that whole thing of, well, expect it. I went through the same training and the same experience, so I want that too. So sometimes you have to have a bit of that discussion.
I love that. We were talking about Founders First and Lyft. You've been a little bit on the roadshow for Lyft, and how has that been received in the different cities that you've gone to? It's just been great seeing you on LinkedIn and all over the place doing great and amazing things. How has it been?
It's been great. Just to, step back, Lyft is the accelerator piece to teach these businesses how to grow and be funded and achieve exponential growth. And then the Founders is the fund piece that helps, that is our fund that supports that effort. We have our platform in such that it is a national platform. So our, signature program is our boot camp. 90% of that's online. We have an on-site component where they pitch and they present to our VIP panel. In order for building the awareness of our brand, we launched this roadshow initiative where it started out just, well, let's go to the East Coast and, meet with a few groups of entrepreneurs and potential angel investors and tell them about, what we're doing in our model and those types of things and learn what is the different perspectives of these entrepreneurs and investors in these other towns. So it was supposed to just be New York and Boston, grew into New York, Boston, Los Angeles, Austin, Texas, San Francisco, and Seattle. We're going to finish up there. There are a lot of other places that said, gosh, well, if you're there, you should go someplace else. And it's like, we'll consider that at another time. But in any case, there is the similarities. There's a few of them. One is expectations and the lack of awareness of all of these different offerings by entrepreneurs in different places. I mean, when I compare my experience when I first started my first company to where it is today, there's so many options. There's programs like yours of what you're doing with Hera Labs and Hera Fund and your, Investor Summit and the pitch days and all of the pitches that are going on to specialized funds that, you're also involved with, Pipeline Angels and Portfolio and all. But the interesting thing is in all of these cities, many people don't know about them. And then the other side of it, you have angel investors who may have been involved with just a little bit of angel investing in their local community, but may not be aware of there's platforms to teach them about either how they can support their portfolio companies or that can teach them how to get involved with supporting a larger batch of companies. So that's been rewarding to share with people about that there are more resources available, which was great. The other interesting insight is having them be aware of, it's not just one of those things that you have an idea and you're going to get someone to write you a check. There is validation steps that you need to go through. And those validation steps, they're with these new funding sources, they're not just because, who you are is preventing you from it. There's things you've got to do. And if you do these things, then you better your chances of getting access to capital. It's not just I'm a woman or I'm a minority, and as a result, I'm not going to be able to get access to funding. There is paths to get there.
And that's one of your focuses, correct, is this results-driven financing. And I think that's so important for entrepreneurs as well as angel investors to really understand that obviously in the last couple of decades, it is who you know. But now that we have all these platforms and all these opportunities, it's really about creating that value of your startup in the ecosystem. And that drives right into that results-driven approach to, growing that startup. So walk me through a little bit about this results-driven financing. And part of it is that economics of traction as well that we just talked about too, is just, what are the milestones? How are you getting it done? How are you getting that traction? Let's break that down a little bit. Certainly.
That's one of the tenets surrounding our funding model. We fund businesses that are revenue generating. We have ours as a revenue-based fund in such that we won't fund a business that is pre-revenue. We won't fund a business that has revenues less than $250,000. We won't fund a business that from a margin standpoint is less than 35% margins. We have the expectation that you're going to have that you either have or just launching a recurring revenue piece, because all of those things have to do with performance. If you have convinced, dozens or hundreds or thousands of people to pay you for what you're doing, then you're adding significant value. When you don't do that, there's a huge amount of risk associated with it, because just because of, you, the entrepreneur, and your investor, have a meeting of the minds and say, yep, this sounds like a good idea. The biggest impact to, having that really work out or not is having the customers vote with their pocketbook, if you will, to say, yep, you're really solving a problem. If you get the more and more of those customers that you get to vote with their pocketbook and say, yep, you're who I picked, and to have them do it on a recurring basis, that's a huge, huge validation point. And that's that results that are necessary in order to have some predictability around being able to deliver value. And delivering that value allows you to provide a return for your investors that are investing in that business. Having that entrepreneur understand kind of all of those economics to actually delivering on that value point. There is a misunderstanding, unfortunately, that many entrepreneurs have, is that I'm going to go through and I'm raising $1 million or $1.5 million and $2 million. And it's like, and what is it that you're returning back to that investor? And when it really breaks it down to how are you going to give that return back? And what is the chances of those things occurring? They don't know. they have no idea of that value delivery piece. And as a result, without that understanding, it really can make it difficult for those early angel investors to get over those concerns.
And I think that it's both sides too, because I find that I always tell entrepreneurs the same thing you said. Okay, you need to have that value. You need to have those results driven approaches, but it's also the angel investor who you're trying to train as well, saying, okay, how do you get this? How do you get this out of the entrepreneur? What do you expect from them?
Exactly. Because that's really core to our program and funding model, we help teach them that, with that predictability, having a recurring revenue stream, being able to measure your performance related to that, you'll be comfortable, you, the entrepreneur, will be comfortable because you'll be able to see the things that you're doing of what's working and what's not working and be able to make those adjustments appropriately. Because when it's like, well, it's a bit of a mystery I'm trying to raise $1 million. Okay, you're trying to raise $1 million. Well, what type of return is the investor who's going to invest in that going to need? And understanding that when you are trying to raise that $1 million, how many people does that make up to get to that million? You're not going to just find someone who's just going to write you one 7-figure check. Not likely. There's always that possibility that you might find someone that do it, but it's, generally like 1%. Mostly you're going to have to collect a series of 10, 25, 50. Maybe you'll get some, 100 or a couple 100,000 checks, but it's first, starting small and being able to get that support.
And you give that support to the diverse leaders that are out there. Because I think that's one of the things that we find with women and diverse leaders is that we don't have access to that capital. Through that accelerator, you allow them to have those connections with the right people, the smart money, basically.
Yeah. And understanding, what the expectation is for an investor who is going to make that. I mean, the investor could be us through our fund. Or if it's not, that you're going to be able to demonstrate that you're giving that return. The standard answer is, well, we're going to be bought by somebody else. And as a result, by being bought by somebody else, then we're going to give that return back to our investor. And our model, because it is revenue based, for a dollar of revenue, they pay back 5 cents to a certain cap. And, as a result, we distribute that to our investors, our LPs on a, frequent basis. So they're not having to wait, 3, 5, 10, 12, years to expect when is this company going to get bought so I can get a return on my investment. And as a result of that, with this liquidity that we provide in our business, our interests are aligned with the entrepreneur because our goal is to help you grow top line revenue as well as having a level of profitability in place. And with our interest being aligned in helping you grow your business, you're going to, pay off your investment sooner. It will also provide a way for attracting other investment in this type because you have that liquidity piece that happens. You compare the Bay Area compared to many other cities, the thing that makes it work is all that liquidity, is that those investors get paid back so much faster than the typical 5 years. Not always is it, 5 years, but, there's a company being bought every day, or there's several companies being bought every day and returning those funds back to the investors. And as a result, those investors are investing in, net new deals on an ongoing basis.
I love that. So you're giving that control back to the entrepreneur. And of course, that anti-dilution is so important for them to be aware of, correct?
Yes, our model is a revenue-based model. So we don't take an equity stake or take a significant equity stake in the company, nor do we ask for board seats on the business. As a result, some of those traditional equity rights like anti-dilution, liquidation preferences, and all of those things, they're not having to deal with. They keep the ownership of their company and they have that specific control and are, as part of our diligence process, making certain our interests are aligned with how they're growing their business. But our goal is if they they win, if they're making money, if they are building wealth, then guess what? Their investors are too.
And are those investors also looking at it as a different asset class? Because I know that we talk about that at the Angel Capital Association meetings, is that all of these are different asset classes of angel investing, VC, and other aspects. Are you talking to your investors in that aspect so that you can give them more value in a different way?
Yes, exactly. Because of the return model, on the one side, our risk profile is not that of an equity investment. So for someone who does diversify their investments, there's some things that they're going to invest in publicly traded securities. Then you have the other risk side of the profile, which are private, early stage company investments. Ours are in the middle or closer to, the more predictable distributions. Because we pay out the quarterly distributions, they're not having to wait for that. Because there's less risk than waiting, 5 to 10 years, the IRR is, a little different, but, it's a much more predictable profile. But given the profile of our investors, those are people that are looking for, an income stream from their investments to, basically complement the fact that they're not going to get it from on the other side. Another piece in their diversified investment portfolio.
Are you seeing that there's more women that would like this type of asset class? Are you seeing more diverse investors liking that because of the liquidity aspects of it and lowering that risk?
Today, our profile of investors are people, believe it or not, that have invested in other type of revenue-based private equity funds. We see the opportunity to invite others, but the classification of investor is a little different. Our minimum participation level in our fund is higher than some of the other micro investment levels, given the level of diversity that we are seeking on the other side, or as one person I was just speaking, ours is an impact fund. We look to provide a return of a double or triple bottom line, because not only is you got the economics associated with it, you have this serving this underserved market. And many of these companies with their solutions are, solving a significant problem, either in their community, in the industry, or the marketplace, a social problem with their offering. So the hope is that, we will have more diverse investors in what we're doing. But the ones that are getting it immediately are the ones that have invested in similar type of royalty stream private equity.
I love that, because I talk to that specific concept to a lot of different investors. So I love how that kind of plays into that really well. Kind of going away from, let's say, the investment aspects and all that, I know as a serial entrepreneur yourself, you really have this way of looking at the glass half full in a lot of markets and a lot of new solutions that are out there. We talked way at the beginning that you look at challenges and you solve problems. So what are the new solutions that are entering the market for gaining access to risk capital for diverse founders?
There's, I want to say dozens more solutions out there. More of them, I shouldn't say 25% are on the equity side, but there's some that are quasi-equity debt related, and that's kind of where we play. I would say that there's more of those in the marketplace, but the good news is there's more of them. There also is the need for the entrepreneur to be very capital efficient with use of capital. But the good news is you can do that, especially if you really focus on solving the customer investment piece. And the whole new lean startup methodology allows for that. So there are a lot more those types of programs available now than there used to be. And that allows them to get access to anywhere from, $50,000 to, a couple of $100,000 with the appropriate performance and expectation, which is great news.
I love that. That's really important for everybody to kind of understand that on both sides of the venture table, because that's how we drive that progress forwards.
You think of when, Bill Gates, when he said, someday there's going to be a computer in every household. And in reality, there's multiple computers in every household. I look at it as with what we're doing, we want there to be a defined, predictable, reliable path, an entrepreneur to go from 0 to 10 million if they want to. And it's not so much of a mystery. That's where we want to be able to help these companies be able to get to.
Wonderful. What else can we talk about the roadshow and what you are really diving into? Because there's so many little nuances that whenever we talk, it always feels like there's and. So is there anything else that you've found through this last year of really diving into, Lift and really making Founders First more rigorous in the accelerator, all of that you're doing?
I would say there's a few things. There's an opportunity, there's the perception with regards to businesses. Some folks think that, there's a lot of resources that are attracted or directed to startup, companies going from ideation to, generating their first $1,000, $10,000, and that's the group that needs help. The reality is that, there's all kinds of statistics that says 1 in 5 businesses or 2 in 10 businesses fail. And if you put businesses into 4 buckets or 5 buckets, and they were in those buckets between going from 0 to 10,000, 10,000 to 100,000, 100,000 to maybe $500,000, and then $500,000 to $1 million, and then $1 million to above. That bucket, those last 4 or 5 buckets of going from 10,000 to $1 million is a mystery, and it has been such a mystery for so many businesses, and it doesn't have to be, but there's so much about that statistics that's quoted that, 2 out of 5 or 1 out of 5 fail, or 1 out of 5 businesses succeed, which means, 4 out of 5 fail. And it's because of understanding those other buckets. It doesn't have to be so much like magic, but, there are so many different groups that impact that, from the capital markets to the supplier markets, the entrepreneur, and they all have operated in separate little silos. So if you didn't know how to navigate between the groups, you're stuck. And many times being stuck means you're done. If you just kind of, what's the saying goes, you just working in your business as opposed to getting access to other resources, be it a mentor, peer group, accelerator, those types of things, incubator, to help you advance through those other buckets. It really is hard having that, dialogue and having people have that. There's more newer statistics around how successful companies that start in an incubator and accelerator with the right type of support can be, when you get some guidance around having people help you with that expectation, and that you're not going to have to go through it alone. That's the cool thing that's happened. And the other piece is the number of women of color that are starting businesses. That's the fastest group that is starting businesses today, like 3 times. When you think of, African American and Latino women, we're starting businesses at 3 times. And not only are we starting them at 3 times the rate, we are also one of the most educated groups going about it too. So, we've spent time in a career, but we've decided we're going to go through and do this on our own. So some really interesting things happening that are, kind of driving all of this together, that, you get a chance to get up close and personal by being, out in the marketplace and hearing about it.
And supporting them just like you do. I think that's so important for them to thrive.
Well, Kim, given your experience as a founder of several venture-backed companies and having raised over $30 million in venture funding, and then being on the other side of the venture table, investing in early-stage companies led by diverse founders, what do you see are the additional opportunities and challenges for both diverse founders and also investors seeking to fund diverse founders?
Well, Silvia, that's a great question. I would say for the diverse founders, the really issue that many of them need to tackle is making certain that with funds like yours, Hera Fund, Hera Labs, and Portfolio, and CEO, and Pipeline Angel, those are opportunities where you don't have some of the biases that you had before, and you also have those folks given the opportunity to fund based on the merit and performance of your venture. Then it's really important for the founder to focus on really being able to demonstrate that they've de-risked their business venture and that they have successfully proven there's demand for their offering. I mentor dozens of founders, and that can be sometimes the mismatch in that they're in the market raising 6-7 figures of capital, and yet they still haven't successfully demonstrated the demand for their offering. So that's the one side. And then as the other side for the investors investing in diverse founders is that there's such a huge opportunity to do so. While there are some that haven't gotten through the product market chain of their venture, there are many that have made some really great progress. So there's a lot of really impactful ventures. And the other thing that they have to understand is that it takes dozens of folks to invest in a successful venture in order to have it get to that point of scale. In my own experience, where I raised $20 million in venture, I raised that from 40 different investors. It wasn't a small group of people, 30 angels, and then on top of that, a 4 different funds that I raised those funds from. When you compare that to the fact that, there may be 40 or 50 women-led or women-focused or diverse founder-focused ventures that are investing in them and doing it on a merit base, there needs to be thousands of them in order to really have a significant impact. Now, that may sound daunting that there needs to be 1,000 Hera Labs and 1,000 Founders First and Portfolio Funds or Pipeline Angels or CEO, but that also presents a really significant opportunity for newer investors to come into the marketplace and partner so that we can, syndicate and work together to help grow these successful ventures. Just like the guys do. Guys, they go through and they launch a venture and are able to scale it and exit, and then they turn around and they are, many times on both sides of the table, maybe doing another venture, but also exiting in such a fashion such that they can invest in some of the next ventures. That's really the really great, exciting opportunity that we have coming up. So I'm excited about it. We've got a lot of work to be done, but taking it from those 2 key critical steps, that's where we're going to really be able to make a positive, significant, transformative change in funding diverse founders.
I think that we're kind of at the very tail end of our discussion. I always love talking to you and seeing what you're all about and what you're doing and where you're traveling to and all of that. So the last 4 questions that I have for you are kind of rapid fire questions that I ask everybody. The first one is, what's your favorite angel investing resource?
I have multiple. It's been great hearing a lot of the inside detailed stories from listening to the She Invests podcast, in addition to what's going on with Portfolio and even, CEO as well. There's multiple angel investment resources that I think have been helpful. And let me also mention in their Pipeline Angels, they've been a great resource as well.
Yeah, all of them do such different things. So we all collaborate so well together. Actually, CEO founder will be at the Hera Venture Summit pretty soon, the middle of September. So we're really excited to have Vicky coming as a keynote. So the second one is, what's your favorite book?
The book that I was reading when I started my first company some 20 years ago, Why Do White Guys Have All the Fun? And it was talking about how this guy, he was the first African-American billionaire, launched and started his company and his journey into private equity. And, that was such an insightful, interesting read. So that was one of my first and favorite entrepreneurial books, and I highly recommend that for others to read as well.
I love that. The third one is, who has been a major influence in your life?
Wow. Well, as I shared at the top of this session, my dad was a career military naval officer and an engineer, and once he finished his 22 years in the Navy, became an entrepreneur. So from a role model example of how to go about doing what I wanted to do, he has been great. I have to give him the props of saying that he's been a really, really great source of wind that has helped me get here.
Yeah, there's always the influences in your life at the very beginning of your personal life that really dictate how you become a career person. And I love that about your dad, really giving you that impetus.
And let me share one other kind of interesting entrepreneurial insight. So I had a chance to also have another gentleman, and with my first entrepreneurial company, as a mentor to me, phenomenal entrepreneur. So his name is Harry Gruber. You may know of him, but this man has taken over 6 companies public. Just an amazing resource. As a medical doctor by training, UCSD, did his residency. He actually went to a University of Pennsylvania for medical school. It's just a really great resource.
We need those people in our lives to just push us and to think bigger, right? And dream bigger. So with that, the last question is, what does abundance mindset mean to you?
It means that anything is possible, that if you can dream it and see it, then you can make that happen. As many of the people who come through our program, I share with them that, your journey to success is not just yours and your company, but just, you get a chance to be a role model for so many people that you may not even think having an impact for them. And so, if you really want it, it's feasible. It's just you got to recognize it's not a sprint. It's a marathon, and that there's a way that things can happen. All things are possible with, faith and hard work and luck, but, it's feasible regardless of who you are.
And a great network around you. I think that accelerators like yours and what a lot of accelerators are out there, and also angel groups, we all want to network that new great startup that we would love to mentor, that we would love to have them thrive. And really getting into that ecosystem is so important.
Mm-hmm. Right. It's critical. That's really going to make it possible, because you need to have the influences and experiences of other folks. It's so critical. I mean, and you compare that to other industries, be it the entertainment industry. There's lots of examples of that within entertainment and sports and all of those things, that when you surround yourself with that positive resource, including, coaches, mentors, peers, a playbook that plays to your strengths, all of those things can help propel you to really add a significant contribution.
Well, thank you, Kim, so much for being part of the She Invests podcast. It has been a pleasure, as always, to talk with you.
Well, thank you so much. And I am so honored to be able to contribute.
Thank you.
In this episode, Kim Folsom really dives into how we can build up the next generation of diverse founders of excellent startups. She gives 5 tips to really accelerate through either an accelerator or yourselves, 5 things that really will up-level your startup. 1 is understanding and getting the knowledge of best business practices. Number 2 is having a viable growth plan. Number 3 is getting access to committed coaches that really challenge a startup to grow their own business. Number 4 is success work, meaning that you want to transform your business by adding 1 or 2 recurring revenue streams. Number 5 is grow the right team to make iterative growth a reality. Now, with all of that, she also talked about why accelerators really are beneficial. And one of the things that we talked about was pitch day. Some entrepreneurs really don't want to do pitch day, but it is so important because you really get to know the people in the audience, and those people in the audience can be investors. So those investors get to know you, get to know your business, and begin that relationship building capacity between the startup and the investor so that interactions can occur and funding can occur. Kim also dived into 2 aspects that allow for diverse founders to thrive. One is really understanding results-driven financing. And 2 is the economics of traction. That is what allowed startups in the Bay Area to really thrive.
Thank you for listening to and subscribing to the She Invest podcast. Go on over to sheinvest.com for the full show notes for this episode, as well as any resources, websites, and opportunities mentioned during the show. Sign up for the sheinvest.com newsletter to learn about events like our annual Hera Venture Summit during the month of September and our She Invests monthly investor circles. Thank you for your time, talent, and treasure.